Every day, millions of people buy stocks. Some buy because the price is rising, some buy because social media told them, some buy simply because everyone else is buying. But intelligent investors operate differently. They don't chase stocks, they study business. Behind every stock ticker, there is a real company. A company with products, employees, profits, debt, competition, and ambition, and the ability to understand that business before investing is what separates disciplined investors from emotional traders. That skill is called as fundamental analysis. What does fundamental analysis really means? It's the process of discovering the true quality of a business, not the excitement around it, not the hype, the actual strength of the company underneath the stock price. Imagine buying a restaurant before investing your money. You would naturally ask questions. Is the restaurant profitable? Are customers returning? Does it have too much debt? Is the owner competent? Can this business grow in future? That is fundamental analysis. Except in the stock market, you are asking these questions about publicly listed companies. The five signals smart investors study. Revenue growth. Is the business expanding? First thing investors study is revenue growth. Revenue is the money a company generates from selling its products or services. Consistent revenue growth often means one important thing: people trust the business. For example, if a company grows from 500 CR in sales to 1500 CR over several years, it shows increasing demand because strong business rarely stay stagnant. Profit making. Is the company actually making money? Revenue alone can be misleading. Some companies generate huge sales while losing enormous amount of money behind the scenes. That's why investors focus on profits. Profit reveals whether the company can survive, expand, and reward shareholders over time. Growing revenue with weak profits is like filling a bucket with holes in it. Debt. Is growing being built on borrowed money? Debt is powerful. Used wisely, it can accelerate growth. Used recklessly, it can destroy even large companies. Too much debt creates pressure, especially during economic slowdowns, market crashes, or falling profits. That's why experienced investors prefer companies with controlled and manageable debt. Return on equity. How efficient is management? Great companies do not just make money, they use money efficiently. That's where ROE, return on equity, becomes important. ROE measures how effectively management uses shareholder capital to generate profits. A consistency in ROE often signals strong leadership, efficient operations, and a quality business model. Management quality, the human factor. Numbers matter, but eventually people run business, and poor leadership can destroy even a strong company. So, intelligent investors study management carefully. Are they transparent? Do they communicate honestly? Do they allocate money wisely? Do they think long term? Because over time, management decisions shape the destiny of the business. The fascinating part is none of this information is secret. Professional investors study publicly available data, such as annual reports, balance sheets, P&L statements, cash flow statement, investor presentations, include platforms like Screener, Money Control, NSE, India, etc. Fundamental analysis is not about predicting tomorrow's stock price. It is about identifying business strong enough to survive for years. Because true wealth in the market is rarely created through excitement, it is created through patience, understanding, and disciplined decision making. The market eventually rewards those who study business instead of chasing noise.